To begin this lesson, I'll start by highlighting that blockchain technology matters and it is widely believed that it will revolutionize the way people all over the world agree, trust, and transact. The launch of Bitcoin by Satoshi Nakamoto in 2008 and its success in the following years have sparked global interest in the underlying technology behind the successful digital currency, which operates diametrically to the way financial systems in the world operate today. Traditionally, financial systems all over the world are controlled by institutions like central banks, retail and commercial banks, investment banks, and so on. People rely on these institutions to act as intermediaries whenever there needs to be an exchange of value. Contemporary banking practices have a long history. As far back as in ancient empires, third party institutions were trusted to store and create wealth. When the first coins were minted and became the prevalent medium of exchange, ancient Romans stored their coins in the basement of temples. They trusted that these temples were secure because they believed the priests and temple workers were devout and the temple was protected by armed guards. Wealthy merchants increased their wealth by lending coins to people who needed them with the promise of earning an interest on their loans. Temples handled large loans to other monarchs, while moneylenders dealt directly with other kinds of loans. Since temples served as storehouses of wealth, they were targets of ransacking during wars between kingdoms. It was the Romans who separated the banking functions from the worship functions of ancient temples and formalized their operations in distinct buildings. As empires rose and fell, banking practices evolved. A person's debt could be passed on from a debtor through his lineage in the Roman Empire. But Julius Caesar created a law that allowed banks to confiscate property of debtors as a form of immediate loan repayment. In Europe, monarchs took loans from the banks in order to cope with financial difficulties and even finance pointless wars. As a result, Spain became the first country to declare national bankruptcy in 1557, when 40% of its gross national product went to debt servicing. In 1776, Adam Smith introduced his invisible hand theory through his book, The Wealth of Nations. By this time, banking was already well established in the British Empire. The invisible hand theory proposed two critical ideas. The first is that voluntary trade in a free market produces unintentional and widespread benefits. Secondly, these benefits are greater than those of a regulated planned economy. Each free exchange creates signals about which goods and services are valuable and how difficult they are to bring to the market. These signals captured in the price system spontaneously directing competing consumers, producers, distributors, and intermediaries, each pursuing their plans to fulfill the needs and desires of others. Empowered by these views of a self regulated economy, money lenders and bankers were able to limit the state's involvement in the banking sector and the economy. This free market capitalism and competitive banking found fertile ground in the New World, where the United States of America was about to emerge. In those days, each American bank printed its own currency or banknotes, which was used by people for everyday transactions. However, this system of doing business had limitations. Banknotes could only be redeemed by the issuing banks, and so they could not be used in places that were too far from the banks that issued them. Traders won't accept them or will only take them at a discounted rate. Buyers and sellers have to be careful about the banknotes they use because if the bank folded up, all their currency will be worthless. At the time, the lifespan of the bank was only about 5 years before it folded up. There was also the issue of counterfeiting, and banks put in a lot of effort to make their notes hard to copy. All this ended when the US government set up a national bank and issued a uniform currency backed by the bank's purchases of treasury securities. But by this time, the public had grown to distrust banks. In the following years, the US government will set up more institutions, laws, and policies to protect the country's financial interests, and these institutions became the regulatory agencies monitoring the sector to prevent or at least foresee economic setbacks. The Federal Reserve Bank, usually called the Fed, which is the Central Bank of America, was established as a response to the financial panic of 1907. Essentially, member banks could borrow from the Fed when they had no one else to turn to. But even the Fed could not stop more than 9,000 banks from failing between 1930 and 1933, where the stock market crashed on Black Tuesday in 1929. As a response to this crisis, the US government passed the Glass-Steagall Act in 1933 and set up the Federal Deposit Insurance Corps, or FDIC, to insure customer funds up to a limit. Ironically, it was World War II that saved banks, as a lot of companies that needed credit sprang up all over the world. Individually, the banks could not meet the needs of these companies, and so they began to merge. With the advent of deposit insurance and mortgage lending, public confidence in banks grew as the average citizen could access credit to meet his needs. Digital technology enabled the invention of online banking. With online banking, users are able to conduct transactions they would normally perform in a bank over the internet. Online banking increased the accessibility of banking to users, providing them with convenience. Meanwhile, it allows banks to concentrate on those functions that cannot be performed over the internet, like making huge cash withdrawals. People could download bank apps on their smartphones to send and receive money. Some bank apps even allow customers to make requests for loans and invest in stock options from the comfort of their homes. However, although the internet made it convenient for people to perform transactions without going to a bank, this convenience was not without pitfalls and risks. Banking practices did not change over the years, even with the invention of the internet. Using online banking and payment services meant that customers had to give up way more personal information to third parties than they would if they were conducting transactions in person. Banks and payment service providers had to be trusted with a lot of data about customers and had to protect that data from being stolen. Several times, security breaches meant that customers had their data in the hands of unknown assailants, and a lot of the times they lost money. Moreover, the transaction cost of using these services was quite high, even when the amount of money being spent was quite small.